Howdy everybody and welcome back to another stock analysis video. Today guys, we are going to be analyzing one of my favorite companies ever, and that is none other than Home Depot. And I know I've done this company a lot in the past. However guys, we have changed the calculator a little bit since then. And on top of that, their earnings is actually coming out on Tuesday. So I'm actually going to put this out on Monday because when Tuesday comes around, I actually want to make a special quick video when the earnings report come out to actually analyze them a little bit, similar as to how I did with Intel. And I do plan to do the same thing with Lowe's as well, because Home Depot and Lowe's are kind of competitors. So I want to compare these two when they both come out and see how the trajectory for the home improvement stores is actually heading to. So we're going to be analyzing Home Depot, and unfortunately guys, they have been performing very badly recently, unfortunately. So I don't necessarily know what we can expect from a discounted free cash flow perspective. So with that said, let's get started with this analysis. Jumping into the dividend summary guys, Home Depot is an amazing company, especially when it comes to this dividend. Current yield of 2.41%, which ends up being $1.90 per share for an annual payout of $7.60. Payout ratio of 45.08%. Fairly low. However, let's take a look at this in regards to the free cash flow in just 1 second. A 5-year CAGR of 17.57%. That is absolutely massive, with 12 consecutive years of dividend growth. Again, really awesome to see. Ex-dividend date passed as of June 1st. However, if trends continue, their ex-dividend date for the next cycle will probably be in September 1st. Payout date was June 16th. So probably the payout date for Q3 will probably be September 16th. And of course, they pay their dividends quarterly. Let us come now into the calculator, guys. We got the ticker symbol of HD, market cap of $324 billion with a PE of 19.99, which ends up being a share price of $314.89. Now, why did I say that this company has been performing really badly if it's at $314? Well, it's because it's at $314. If all of you know me, you probably know that I do not like it when stocks go up. I am a value investor. I want to buy stocks like Home Depot at a really undervaluation. And unfortunately, Home Depot has actually gone up from a low on the month of around $280 to now, guys, as I said, $314. So that's very sad for us, value investors as well as dividend investors. And even looking at further, guys, Home Depot went as low as $265. So again, really sad that it's currently up. I would have preferred it if it would have gone down even more, maybe to around lower than 265. So that is essentially why. And a lot of people will probably disagree with me on that. They're like, why would you want a company to go down? Well, because when you have a company going up like this, you actually can buy less shares for the same amount of money. Therefore, when it comes to a value / a dividend perspective, you actually make less money. The more you pay for something today, the less returns you're going to have in the future. That's why I absolutely adore bear markets, and that's why I absolutely adore when stocks crash. Unfortunately, right now, a PE of 19.99 and $314, essentially $315 for Home Depot, is telling me that it is a good buy still. However, we're going to use this kind of free cash flow to come up with a better representation. Now, with this annual dividends per share of $7.60, this comes out to be almost $8 billion in dividends being paid out every single year in accordance to the amount of shares outstanding that they currently have. Looking at their 5-year average free cash flow, and then we take that value and subtract the $7.8 billion, essentially $8 billion, we get $4.6 billion that they still have left in their 5-year average free cash flow. And in accordance to their last year's free cash flow, this is at $6.2 billion. And if we take a look at these payout ratios, we can see that it's looking okay. As of last year's free cash flow, they are at 55.84, which is right under my 60% mark. However, in regards to their 5-year average free cash flow, they're at 62.82, so right above my 60% mark. I think it's not too bad. I think they're going to be fine. But that's just something to note that on their 5-year average, it is a little bit high, at least for my personal preference. Now let's analyze some of these fundamentals. Hint, hint, Home Depot has amazing profit metrics if you don't already see them. We got net income 5 years ago of $8.6 billion to 1 year ago, guys, of $16.4 billion. That is an increase of 90% on the dot, and this is very, very consistent. Even during COVID, actually, especially during COVID, they actually went up when it came to their net income and even their free cash flow. And the reason for this is because, well, two things actually. Number one, people were at home. What else would you do? Play video games, which is why a lot of chip companies skyrocketed, and renovate your home, right? So companies like this definitely did very, very good when everybody was staying at home. So when it comes to their net income, this is looking awesome. It's been an increase every single year within the past 5 years. I'm going to essentially give this, guys, not a perfect score, but at least like a 95%. Just because from 4 years ago to 3 years ago, they did increase, but it wasn't like amazing. Now looking at the free cash flow, the most important of all the profit metrics, because this is the one that companies use to essentially do everything. They use this to pay out the dividend, buy back their shares, pay down their debts, make acquisitions, and just overall grow the company. So if you want that $7.60 in annual dividends to be sustainable, you need this thing to be positive, for starters, as well as consistently increasing. Now we have both of them, however, the consistently one isn't necessarily happening. As you can see right here, from 5 years ago, they did $10.1 billion in free cash flow. 1 year ago, it was $14 billion. That is an increase of 38% with a 5-year average of $12.4 billion. But just because this is in the positive, guys, we can see that in 2020, 2 years ago, they did a whopping $16.4 billion. So they clearly went up from 3 years ago of $11 billion to $16.4, and then they came down to $14 billion, proving my point on what I said earlier, that a lot of people were probably renovating their houses. And on top of that, guys, when it came to the housing market, a lot more people were also buying houses as well. It's kind of cooled down now, but I mean, we're still very, very in the deep of it, right? So the more people buy houses, the more houses were going to get renovated. And in 2020, when everybody was staying at home, you could pretty much just guess that companies like Home Depot were going to do fairly good. I would not be surprised if we were to see this again in Lowe's as well. So because of this reason, guys, they did not manage to do the same free cash flow as of last year. So they did come down a little bit. Do I foresee this thing to continue to come down? I don't believe so. But nonetheless, it is something definitely to take into account. Overall, I'm actually going to give this a fairly good score at around like 80%. Maybe 85% is a better representation. I'm going to go with 80% just because it is increasing year over year, but it's not consistent just because of this outlier 2 years ago during 2020. And now looking at the revenue we got 5 years ago of $101 billion to 1 year ago, guys, of $151.2 billion. That is an increase of almost 50%. And on top of that, very, very consistently increasing, right? We got 101 billion, 108 billion, 110 billion, 132 billion. That is a pretty big jump from 110 to 132. But nonetheless, we know what happened in 2020, right? Again, that's what I just explained. And then from 2 years ago to 1 year ago, they did another $20 billion increase when it came to their revenue to $151.2 billion. That's very, very good, guys. Hopefully they can continue this. I personally think that they can continue this. So I'm actually going to put this essentially like, I would want to put it at like 100%, but I don't know if this increase from 3 to 2 and then from 2 to 1 would actually be the same as from last year to this year. So I'm actually going to put this at like a 95% just because I'm a little bit scared that they will not be able to do the same thing this year. And so far, everything that we have seen has just been amazing. However, something that isn't, and I was very, very surprised when I saw this in my last video, because originally I actually took a look at total current assets minus the total current liabilities. Last video I did this company, well, first of all, I didn't have a sweet mic, so you guys can hear me a lot better. But second of all, I started to use the total assets minus the total liabilities. And this came as a shock because, well, they can't cover this at all, guys. They're currently at negative $1.7 billion. Essentially, their liabilities exceed their total assets by $1.7 billion. And to be more specific, we have it right here. Current total liabilities is around $78 billion and assets it's $76.5 billion. So yeah, they're down by a significant amount when it comes to this, guys. Unfortunately, The only years that they were actually positive were 5 years ago, which I don't know what happened 5 years ago, and then 2020, which I can pretty much guess why, right? But overall, they have been deep in the red within the past 5 years. So I cannot give this a good grade, guys, because total assets minus total liabilities tells you whether or not the company will survive in an economic downturn. Now, home improvement stores probably is going to be one of those that might get hit a lot if a recession hits, right? I mean, we're already in a recession, but I'm saying like we actually start to feel it, like layoffs start happening, all this stuff, because, you know, whether you're going to prioritize feeding your family or renovating the kitchen, right? You're going to prioritize feeding your family. So a company like this might get severely hit if we go deep into this recession that we are already in. So kind of worrying that their assets and liabilities are in the negative. Not gonna lie. If we take a look at the average total assets, we get around $59.8 billion. Average liabilities, we get $60.4 billion. And doing this difference, we get $607.67 million. Overall, guys, I have to give this a low score. How low? I'm not fully sure. I think I'm going to go with like a 30%. I mean, it could be a lot worse. I mean, you know, as of 3 years ago, they did a low of negative $3 billion. But overall, they kept that around like the $1.7, $1.8 billion mark. And they're only in the red by $607 million or so. So 30% might be okay, at least for me. Maybe a little bit lower for you guys. I don't necessarily know, but I'm going to go with 30%. And seeing that their liabilities have completely surpassed their assets, it's not a surprise that they have also surpassed their cash flow. Cash flow minus liabilities, we did not have this last time we analyzed this company, tells us if the company's cash flow is able to cover their liabilities. Because as I said, cash flow, it is what companies use to pay down their debts. And unfortunately, Home Depot cannot do this. They're currently at almost negative $60 billion in this difference. And on top of that, they have been getting worse and worse in the negatives within the past 5 years as well. You do not want this. I understand if it's in the negatives, but at least it should be getting closer and closer to zero. Unfortunately, it is not. It's getting deeper and deeper and deeper in the negatives. Average cash flow minus the average liabilities, we get around negative $44.4 billion. I actually have to give this guys a zero. I cannot excuse this at all. They have not even tried to lower this in the slightest. So I have to give it a zero for this. But now looking at the most underrated of all the metrics, we got the shares outstanding. One of the most important metrics that people tend to overlook because, well, people just don't think about looking for it. And it's really disappointing because this is the one that tells you how much the company is diluting you as the investor. And on top of that, if a company pays out a dividend, the more shares that are issued, that means that the likelihood of that dividend being cut is higher because their payout ratio is actually going to go higher and higher and higher. So it's an overall good for the company to be buying back shares. It gives you a bigger piece of the pie just by the fact that they're just buying back shares. And on top of that, their payout ratios decreases as well. And when it comes to Home Depot, they're doing an amazing job at this, guys. 5 years ago of 1.2 billion shares to today of 1 billion shares. That is a decrease in the 5 year of, look at this, double digits, 11.14%. And from the previous to the current year, this is looking at 1 year ago of around 1.035 billion shares to today, guys, of 1.029 billion shares. That is an increase of a little bit less than 0.6%. So it's actually looking really, really good. And what this is telling me is that they're actually taking majority of their cash flow after that dividend is paid to then put back into buying back shares. So if that's the case, which I'm fairly certain it is, I'm like 99% sure that it is, this is pretty much just telling me that at any moment the board could pretty much just say, you know what? Enough buying back shares. Let's put this into lowering down these liabilities because we cannot afford to have this much debt anymore. So they might actually do this in the future. We shall see. But as it stands, they're buying back shares at a massive amount, as I already said. So I'm actually going to put this at a really good grade, essentially like a 95. Now, why not 100%? Here's the reason why. 3 years ago to 2 years ago, they didn't decrease it. They kept it the same at around 1.077 billion shares. So unfortunately, it's not 100%, but 95, very, very respectable and very, very aggressive of share buybacks as well. And now looking at the cash and equivalents, we can see that they currently hold almost $3 billion with an average cash around $3.4 billion. Alright, now let's do a quick summary of their entire fundamentals. We got the net income 95%, free cash flow gave it an 80%, revenue 95%, assets minus liabilities 30%, cash flow minus liabilities 0%, and shares outstanding 95%, which gives it a total grade, guys, of 75%. The biggest issue here is that liabilities, they need to bring down these liabilities because that is what's destroying these two values, and that's essentially bringing everything down, even though it is weighted at 10%. Overall, it's a pretty average company when it comes to these grades. I still absolutely adore it. So let's come over here and use the discounted free cash flow to see what kind of price we would like to buy this company at. And well, if you guys can see right here from the baseline, you guys can see that the baseline for the target share price, not adjusting for debt, is $130. So the current share price is $314. Yeah, this might actually need to drop by a lot, but let's make some assumptions: low, medium, high, 3 different factors: revenue growth, the projected share buyback, and the required rate of return of 10%. So coming over here, guys, to the Home Depot growth tab, we can see that revenue growth forward is 6.68%. The revenue growth year over year is almost 8%. So let's actually be a little bit conservative and figure out what kind of revenue growth they'll have in the future. I'm actually going to go a little bit below what they're currently saying at the lowest one that we see right there. And I'm going to say, for the low assumption, 6%. For the median assumption, let us say 7%. And for the highest assumption, let's go 8%. So it's fairly close to what the growth assumption is saying right here, right? 6, 7, 8. So let's actually see what this gives us. And now on top of this, guys, for the projected share buyback, we see that they have bought back 11% of shares in the past 5 years. Will they continue to do this? Probably not. So let's actually put these values for the low assumption at the worst one at around, let's just say 5% for the low assumption. For the median assumption, let us say 8%. And for the highest assumption, let us say 11%. So we're saying that for the highest assumption, they're going to buy back shares roughly at around the same rate. For the median assumption, 8%. And for the lowest assumption, we'll say 5%. And now looking at this, guys, we do get some valuations for the target share price, not adjusting for debt. Low assumption, $169.33. Median assumption, it is $180.67. And the highest assumption, it is $192.78. Now adjusting for debt, the way we do this is we take the cash and equivalents, we add the net debt. If they have more debt than cash, then the value comes down. If they have more cash than debt, then the value comes up. We just saw, guys, that they have a ton of debt, right? So this value actually comes down to $125.59 for the low assumption. Median assumption, it is $135.57. And for the high assumption, it is $146.26. Now I like to add a margin of safety on top of this, guys, of 5, 10, and 15%. And this puts me between the buy range of $106.75 to $119.31 for the low assumption. For the median assumption, it is $115.24 to $128.79. And for the highest assumption, we get $124.32 to essentially $139. Guys, the current share price is $314, essentially almost $315. So a lot of you guys are saying that is insane. It needs to fall by like a little less than half. That is absolutely crazy. And also that will never happen because the lowest that it was at around like the $260 range, right? However, guys, understand that when it comes to valuations of a company, this share price that you see right here is based off of market sentiment. At the end of the day, the market, in the short term, it is a voting machine, and in the long term, it is a weighing machine. What that means is, in the short term, the stock price could do whatever it wants based off of how many people buy it and based off of hype. But in the long term, eventually the price comes down to their fundamentals. So in order for me to actually justify buying this company at the current share price, the fundamentals have to get significantly better. That's why I'm actually doing all of these companies when earnings come out, just to see if, hey, let's see what in the world they're doing this quarter. We may want to change our perspective when it comes to these assumptions. I'm going to make these assumptions once again when the earnings come out based off of what we see, and check out if maybe we would actually like to buy it when we see those earnings, right? If the earnings comes out really good, then, you know, let's change these numbers. Because at the end of the day, guys, every investment is the present value of all future cash flow, and this is not financial advice. It never is. That's why, again, every single video I promote this. You guys should have my calculator. It's available for free. Anybody could have it. I also have a book value ratio calculator, a reevaluation calculator, and a dividend tracking sheet, which is where I essentially track all my dividends. And in fact, here you have right here, Home Depot. I own this company. I have invested around almost $2,000 into this company, and they're paying me $13.31 in annual dividends, currently up $244.02 in capital gains. So I'm over here telling you guys that the company should fall, even though I own the company, because if this thing actually falls, that means it's allowing me to buy this company at great valuations where that dividend is going to go far and beyond what I would normally think about, right? So that is essentially why I promote these kinds of investing, and not just like, if the company's so bad, then why is it going up? I don't know why it's going up, because people are buying it for no reason. I personally am not buying this company at $314. I'm also not buying it at $260 either, right? Because I see it as too expensive. I would like to buy it between preferably 180 to 192. That's just me. If you guys do not agree with my assumptions, which if you don't, right, again, have these calculators, because if you think that the company will grow at like 15% and that they'll buy back shares at like, I don't know, 15% as well, well, there you go. Now your target share prices is $253, which is significantly closer to what they were just a couple weeks ago, right? They were what, 262, 253. At that point, you may consider buying that premium. So that just goes to show that everything can change once you change these numbers up. Again, not financial advice, make your own assumptions. All I'm asking for in return, guys, for these free calculators is just help me grow my channel. Thank you so much for everybody who have subscribed. And, you know, it really does motivate me to make these kinds of videos and even make new series, which I guess I consider these earnings, like going over like earnings report now a series apparently. I've done it with Intel and AMD. I like it. I might continue doing it for other companies as well. So yeah, if you guys enjoy this kind of content, if you guys having these free calculators and even live streams, I'm not asking for any money from you guys. I'm not asking to subscribe to my Subscribe Star or Patreon or anything like that. All I'm asking for is just hit the like button, subscribe, and just help me grow my channel by telling your friends about my channel and bringing them over on board to this investing community. But now with that said, guys, let's actually see how much you would get off of this company from their dividend if you were to put in 1 month's income at the average monthly income in the United States of $5,725. And at the current share price, guys, which again, I'm saying it's expensive, this would buy you 18.18 shares. And at the current annual dividends per share, this comes out to be $138.18 in annual dividends, quarterly dividends of $34.55, and a monthly dividend of $11.52. Now, I actually want to try something here. Let's come over here and put this value to like $185 and see how much in dividends you would get now that the share price in theory has fallen to this amount. And if we scroll down here, guys, take a look at this. If the price of Home Depot were to drop to $185, the annual dividends would be, guys, $235.20. That is a massive difference. Quarterly dividends of $58.80 and a monthly dividend of $19.60. Now, what I consider dividend efficient is if like a company pays you out $100 in annual dividends for $2,000 invested. So let's actually do that. Let's put in $2,000, as we can see right here. Annual dividends is now $82. That's fairly good when you think about it. Imagine getting $82 a year just by not doing anything, right? That's absolutely insane. And actually holding this kind of company that went from $262 to $314 in the span of like a week. That is absolutely insane. So again, it just goes to show that whenever you overpay for something, you get less returns, even in dividends. Imagine if I were to tell you for $5,725, you get an increase in your income of $235 a year. That's absolutely insane, and that's amazing. That's why I want this company to fall so badly. Hopefully in the near future, this recession gets worse and it does fall a significant amount. So all in all, guys, as I said, I love Home Depot. I own this company. It does pay me a dividend. It's just too expensive right now. Unfortunately, it is. Even when it fell down to like $262, it was still too expensive. I am sorry to say, it just is. I would love to buy this company so much. We'll see what the earnings report says. And also, we're going to analyze Lowe's as well. And we're going to see Lowe's earnings report and compare it to that of Home Depot to see where in the world they may go. For all you know, their earnings may come out tomorrow and they're awful and the company falls like 10%. Imagine that. Imagine if Home Depot fell to like, I don't know, like $250 in like the span of like 2 days. That is amazing. Still expensive, but that is absolutely amazing. And my suggestion at that point would be to dollar cost average on the way the company goes down. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help her with the algorithm on YouTube. Thank you so much for everybody who have subscribed already. You guys can follow me on my new tech sites, link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video where we're going to check out lows.